You want to start your personal finance journey, but you don't know where to start. How's it going, guys? It's LooseArrowBoy. Don't worry, with some careful thought and planning, you'll be all set. How's it going? It's LooseArrowBoy, and today we're going to set the foundation for our personal finance journey. You'll always hear things like, invest all your money, buy Bitcoin, don't rent, own, buy a used car, and stop buying avocado toast. Well, I'm here to help you develop a basic plan that if you follow, will build a strong foundation for your financial journey. There are very complicated, specific flowcharts out there that you can follow, but it basically breaks down into this. Number 1, budget and create realistic goals. Number 2, build an emergency fund. 3, take advantage of your company match. 4, pay down high interest debt. Number 5, save for near future large purchases and pay down low interest debt. And 6, invest for the long term to assist in retirement or other goals. It could be a bit daunting at first, but we'll take it one step at a time and explain how exactly to start each one. Before we can start investing, we need to handle day-to-day expenses. We can't plan years ahead if we can't even manage 1 month of expenses. First, we need to know where our money is going. And ultimately, I know you don't want to do it, but make a budget. So we need to calculate your monthly income. I highly recommend calculating your net income and not your gross income. You don't want to overestimate your income because personally for me, I'd rather find out that I have extra money than realize that I have not enough money. After you calculate about how much you make per month, we move on to the next step. Next, we need to find out what your necessary expenses are. This would be your minimum debt repayment, your rent, health insurance, car insurance, and utilities. Once you have that number, subtract it from your income. Now you know how much disposable income you have to work with. Before we move forward, we should set some realistic goals. Setting a realistic goal will help us determine if we need to increase our income, reduce our expenses, or just change the goal. One of the best general goals to start with is what your retirement goal is. If you want to retire with $1 million, you need to calculate how much you need to save in order to reach that number. If you had about 30 years before retirement, you need to invest and save about $8,174 a year at an 8% APY, which is about $682 a month. Now you take that number and you check to see if it's possible with your income and current expenses. If that savings number is more than 80% of your disposable income, consider changing your goals, increasing your income, or reducing expenses so that you have more wiggle room for this savings goal. For example, let's say that savings goal is 100% of your disposable income. Well, now you don't have enough money to buy food, groceries, or clothing. So you need to make sure that it's a number that you're comfortable with. Once you have your goal set, the next question is, where should your money go first? Personal finance is personal. So as long as you understand and are ready to face the consequences of your actions today in the future, no choice is wrong. This is what I recommend you do. 1, save at least $1,000 for emergencies. This is to act as cushion against sudden expenses. It will help you pay for them quickly and avoid the need to add debt to your current expenses. Save this money in a high yield savings account so you get a little bit of interest while you're holding this money. Number 2, now that you have your emergency funds, it's time to take advantage of your company match. Most employers will offer to match your contributions to your 401k. For example, if they will match up to 6% of your salary, that means if you contributed 6% of your salary, they will also match that amount, totaling a 12% contribution to your 401k. You are basically doubling your money with no effort. Number 3, it's time to tackle high interest debt. Any debt that is higher than 5%, you want to pay off as soon as possible. It might not be as exciting as seeing your wealth grow, but think of it this way. Every $100 you pay off is another $5 saved from interest. It is a guaranteed 5%, and that is more valuable than potential 8% APY over a 30-year period, in the short term at least. Number 4, revisit your emergency fund and increase it to about 1 to 6 months of expenses. The goal here is to make an emergency fund that will sustain you even if you lose your job. When you're done doing this, you'll feel confident enough to put your money in areas that aren't easily accessible to you, such as assets and stocks. Number 5, This is where you save for your short-term goals. If there's something you need to use your money for within 10 or less years, this is when you start saving for it. For example, if you needed a 10K down payment in 5 years, you need to allocate at least $167 a month into the savings to guarantee you will hit that 10K goal in the 5 years. At this step, also consider paying down low interest debt that is about 5% or less. It may be beneficial for you to eliminate this debt if the alternative for this money isn't wealth building assets. Number 6 is where we begin to save for our long-term goals. Long-term goals are targets that are beyond a 10-year period. This is where you'll invest money for your retirement that you will not touch for 30 years. Increase your income contribution, open a personal tax advantage account, or open a taxable account, depending on your personal goals. If at this point you are not meeting that $682 per month, then you will need to reevaluate your income, expenses, and goals. If we go back to that 10K down payment, maybe that's eating into your long-term goal. So instead of a 10K down payment, maybe you need to change it to an 8K down payment. If that number is non-negotiable, maybe you need to change your time horizon from 5 years to 8 years. These are the conflicts that you'll run into as you create your goals and your budget. Doing this planning will ensure you hit your short, mid, and long-term targets. If you follow these general guidelines, you're setting yourself up for a solid financial future. Even though these are general guidelines, they might not exactly align with what your wants are. Let's go through how I personally go about planning for my financial future. Starting off, I highly recommend calculating your net income after taxes and contributions. What I did was take about like 5 pay stubs and divide it by how many weeks, so then I have my approximate income per week, and then I can multiply it out for a year or a month when needed. This is actually a budget that I set in 2020 when my salary was about 45 to 47K at the time. As you can see, for pay period, I calculated a $1,300 salary, and if you come down here, my gross income was calculated as $47,000, but I calculated my net income as $32,000. This is where I started to make my allocations and subtracting my expenses. Remember, I would rather find out that I have more money than find out later that I don't have enough money. So the next thing I did was add up all of my expenses. Here, this is where I put my bills, such as life insurance, car maintenance, gas, and things of that nature. If you have expenses that are 1 year or 6 months, remember to include that within the entirety of your budget. So what I did first was save up about $10,000. And then from there, I decided to start investing my money. I was already contributing to my company match, and my biggest goal was to create a large enough portfolio that one day I would be able to use to substantially supplement my income. I was not targeting $1 million in retirement. Instead, I was trying to get to a substantial portfolio amount as soon as possible. So what I did after subtracting my expenses from my income was to find out how much I could invest per week that I would be comfortable with. For example, I calculated how much money I would still have left if I invested $10,000 a year. I typed in $10,000 here, then I checked to see how much discretionary funds I had. I calculated that I would have $343.07 to spend on myself every week, but I thought that was too high, so I decided to increase my investments. I just kept playing with the number, so I went up to $15,000. I went to check my discretionary funds again, and it said I had $246 a week to spend on myself. But I still consider that too much. That might be just enough for you, but in the way I was living, I thought it was way too much. Eventually, I settled on $25,000 a year. What that left me with was $54.61 I could spend in discretion. I could spend this on like video games, random food, just random stuff that I wanted. Remember, I already budgeted in things like fuel and cart maintenance, so this $54 I was safe to use and I felt confident in using. So with this budget plan, I set up my bank account to automatically invest $480 every week in my portfolio. And because I had this $55 limit, every week and every day, this limit was always in the back of my mind. If I went a little above this limit, I would have to subtract my limit the next week. If I was completely under that limit, I could roll it over to the next week. So if I wanted to get a cell phone for $500, that just means I would have to limit my spending every week until I had enough money to purchase that phone. Using this strategy and budget, I reached a net worth of about $100,000 at the start of 2021. If you want to track your spending in other accounts, I highly recommend using Mint. The sooner you use Mint, the sooner it will start trending your patterns of purchases and savings over time. Mint will allow you to integrate your bank account, your investment portfolio, your credit cards. It's a great overall way to track your finances. So I followed this strategy for about 2 years. During this time, I incorporated my raises and made sure that I was allocating more money without adding too much discretionary funds that I didn't need. In that 2-year period, I accumulated a net worth of about $160,000. However, my strategy did overlook one of my goals. During the time, I didn't think I could be a homeowner because I didn't have a high enough salary. Today, I'm in the fortunate position that I could be a homeowner. Unfortunately, I never saved long-term for a down payment on a property. As a result, I recently had to change the allocation of my investments. So instead of putting money into my investments, I'm putting money directly into savings so that I can hit my target goal. Use this as a reminder to plan your short-term goals with your long-term goals. There is no perfect strategy for everyone. Developing your own based on sound fundamentals will put you in a great financial position. Even though I personally neglected to save for a down payment, I still have the option to take from my investments. That wouldn't have been possible if I was irresponsible with my finances and didn't have a plan to begin with. I hope this gives you guidance and confidence to start your financial journey. Leave a like and subscribe, and join me in the After Hours episode where I will go in depth about my successes and shortcomings following my strategy. Let's continue this journey together, and I will see you all next time.